Hi, everybody, and welcome to TradeStation for today's outstanding trader webinar that we have planned. I'm Don Prattle from TradeStation, and yes, this looks a little different than a lot of our regular presentations. We don't often start you out with a quiz. Our friend from optionstrategist.com, Stan Freifeld, is the Director of Corporate Services and he's the head mentoring instructor. The optionstrategist.com is part of the McMillan analysis group. And if you're an options trader like me, you know that the Bible of option traders is the Options as a Strategic Investment book written by Larry McMillan, and Stan Freifeld and Larry McMillan operate the McMillan Analysis Corporation together. Stan Freifeld himself was a floor trader at the American Stock Exchange, where he traded options for his own account from 1994 to 2001. He was a market maker for the options on several active equities. His knowledge of the rules and the regulations of the exchange combined his reputation for honesty, integrity, and fairness, and it enabled him to be appointed as a floor official, where he served on several exchange committees back then. Now, these days, Stan works as a mentor, helping other option traders become better at their craft. When he's not trading, Stan relieves his stress by playing squash, competing in road rallies with his Ferrari, and tutoring local students for the SATs. Stan is a longtime Mensa member, and he's an engaging teacher with an extraordinary background in options trading and risk management. He's really, really helpful and patient by nature, and he's equally at ease with all levels of traders, from beginning novices to advanced pros and academics. So Stan has this method of starting his own webinars with a quiz, and so we're working with that today. Stan, welcome to TradeStation, and thank you for helping us out with our option trading today. So what are the answers to the test, my friend?
Well, I normally give the answers at the end. If you'd like, I can give them now. And sure.
No, you don't have to.
If anybody has sent them, I will take a look later on. And if you got two of the three correct, I'm going to send you a free 3-month subscription to our flagship newsletter. But the answers are: number 1, he's looking at his sun. Number 2, Sunday. And number 3, 50%. Number 3 is very counterintuitive. But think about that. If you have 23 people in a room, there's a 50% probability that 2 will have the same birthday. Anyway, I hope you enjoyed the quiz. Don, I want to thank you very much for that introduction. I'll have to record it and let my kids hear it. Yeah, that's the nicest thing people have said about me. So thanks a lot. Thank you for allowing me to talk to your group here at TradeStation. I think it's great that you have these webinars where people could learn how to trade. You know, trading is tough. People think it's very easy to just go out there and start trading and taking money from the markets. Not the case. It's a lot of hard work. We're talking about something that really is a zero-sum game. Some would even say a negative-sum game, because we have expenses. And so to be successful on a consistent basis, you have to work a little harder than the next guy. You have to be a little bit more motivated than the next guy. And when I say guy, I'm talking to male or female, of course. But you also have to use the best tools that are available, and TradeStation is right up there as one of the best for sure. And then you also need to have a very good options education. You want to know what you're doing, so that when you run into a problem, or when you're looking at scans or setups, you understand what's really happening. You don't want to rely on luck or other aspects of trading that you don't control. That's my, well, what do we call that? That's my message for the day. Some say I give a sermon before I start. No, it's my message. All right, let's move on. I have a lot to talk about, so let's get right into it. or the presentation today. It's the glorious gamma, the misunderstood Greek. As Don said, I'm director of MAC. MAC is McMillan Analysis Corp Mentoring. And today's the date, right? November 15th. Hard to believe how quickly time is moving forward, but so be it. All right. So first I have an outline of my presentation. I'm going to tell you a bit about who I am. Then I'll read our disclaimer. Our attorneys charged us to write it, so I guess I better read it. I'll talk about the Black-Scholes model a little bit, and then we'll really get into talking about gamma. And as an introduction, I'll explain a little bit about what the Greeks are in general. And then specifically today, we're going to talk about gamma, because I think gamma is really misunderstood by a lot of traders. I've heard some people say gamma isn't even important, when in fact, I believe it's critically important. And depending on how much time we have, I have some bonus formulas and some examples that I'd like to share with you. These are things that I used when I was a floor trader, and I haven't seen them in too many places off the floor. I think it would be useful for this group to know about them, and I'll try and show you what they are and how they work. If possible, I'll take questions at the end. Sometimes I run out of time. I don't want to hold people more than an hour or so. So if you do have questions, I'm going to give you my contact information. You could send them to me. I always respond to questions. In fact, I'm probably one of those weird guys who likes talking to option traders. So if somebody has a question, they could feel free to email me or even to call. I can't always take a call at the time that you make it, but I always get back to people. Okay, so let's move on. Oh, here's a picture of me when I had hair. That's why I use it. I'm wearing my trading jacket from the floor of the Amex, the American Stock Exchange. I'm not going to read this, but you could take a quick look at it, give you some idea about my background. Some of the information is what Don mentioned in the introduction. Also, I was an actuary for 20 years before selling a pension consulting company I was a part owner of, and using the proceeds to go into trading. That's how I became involved in trading options. Okay. All right. And here's my contact information. I'll show it again at the end. Phone number is 973-362-4558. The email, very simple, my name, Stan, and then our website, optionstrategist.com. If you want a PDF of the presentation I'm doing this afternoon, and also we're going to have some special deals available for you, just go to the website, optionstrategist.com, and put /TS for TradeStation 18, TS 18, okay? Here's the disclaimer. All right, I was told to read it, so I will. I'll read it quickly though. Presentation is for educational and informational purposes only and should not be construed as a solicitation to buy or sell options or other securities of any kind. Also, we are not advertising or recommending the use of the strategies or techniques described herein. There are multiple risks inherent to options trading that may expose investors and traders to potentially rapid and substantial losses. You agree that McMillan Analysis Corp, and especially Stan Freifeld, I'll throw that in, are not liable for any trading losses or other consequential damages you may incur. Option trading is not suitable for everyone, and to learn more about the risks of option trading, you could see the publication by the Options Clearing Corporation, the characteristics and risks of options trading. Okay, and there's the website, the link to it if you want to get a copy of it. Okay, so I'm going to start out just giving a little information about the Black-Scholes model, because a lot of what we do is based on having a model. It doesn't have to be Black-Scholes. It's what floor traders used, especially years ago. It was the only one that was really available when I was trading. And although other models had come out, Black-Scholes was very quick. It was the kind of thing where when I had a handheld computer, I could hit enter and the information that I needed would appear. It would seem like instantaneously. If I used another model, something called Cox-Ross-Rubinstein, I'd have to count to 5, and by that time the trade was already gone. It was carded up and printed. That's trading language for meaning disseminated to the public. That's what it means to be printed. Anyway, the model was published in 1973, and that's the time that options started trading on exchange. In 73, you had, I think there were 20 options that traded. They were all calls at the time. They weren't puts. Puts came in two years later. But the model was used for calculating the theoretical value of an option. The authors won a Nobel Prize. Now, there were actually 3 authors. It was, what was his name? Fisher Black, Myron Scholes, and Robert Merton. Unfortunately, Fisher Black died before the award was given, before the Nobel Prize was given. And so he didn't get it, although he was talked about a lot during the ceremony. And it's a shame because there is a monetary prize that goes with it. I think it's $1 million. But anyway, the model itself, it's not perfect. In fact, no model is perfect, right? Otherwise, it would be whatever it's modeling. But it assumes European style options, which means, and just to make it clear, a European style option is an option that can only be exercised at expiration. So of course, not only can you not exercise it, but if you're short, there's no early assignment risk. There are no dividends. The model assumed no dividends, although a term for dividends was added later on. It assumed constant interest rate, constant volatility, and continuous hedging. Okay, here's the model. We'll spend the next half hour talking about the formula. No, I'm only kidding. I just have it up here to show you what's involved. And the truth of the matter is that using the formula is relatively straightforward. It's very easy to program it into a computer or even an Excel spreadsheet. But it was developing it that won the Nobel Prize. That's what the guys who developed it got the Nobel Prize for, the development. The variables you could see what they are. The output is C for call and P for put. The variables being stock price, S for stock price, X for exercise price. Some people tend to use K for strike price. I always use exercise price. That's where the X comes from. T is time to expiration. It has to be in years. V for volatility, and R for the risk-free interest rate. And then some of the other symbols are defined over here. Ln is the natural log. E is the base of the natural log, which is 2.718, et cetera. It's a transcendental number. Nx is the cumulative normal distribution, and then prime x is the normal distribution. The original, like I said, formula did not include dividends. That was later on. You can see that comment on the bottom there. Okay. So let's talk a little about the Greeks. Just like you wouldn't and certainly shouldn't drive a car without gauges, your speedometer, your gas gauge, etc. You probably shouldn't manage an options position without the proper information. And the Greeks are your gauges. So think of it that way. You have to use your Greeks to run the options position, or you don't have enough information. And again, it's a very competitive business. We want to know more than the next trader, more than the next person, okay? Not even as much. We want to know more. And that's going to make us successful because there are a lot of opportunities when we're trading. We just have to know how to take advantage of them and what to do when they go wrong. Again, we're not really going to focus on this, but I wanted to show you how the Greeks are calculated mathematically. It was all part of the original paper Um, it appeared actually, I think it was the Journal of Economics, where the original Black-Scholes model appeared, and all these formulas were in there. And when it first came out, it was only for calls. About a year later, they modified the formula or added to the formula to come up with a formula for puts. Okay? All right. Now let's talk about what the Greeks are. These are we're going to use the practical, not the mathematically precise definitions. And it's kind of interesting. The four of them are really quite similar because they all start out with a change in the option price relative to something. So we could see delta is the change in an option price or premium relative to a $1 change in the price of the stock. Now I purposely, I have delta and D for dollar. So we have a mnemonic here for four of the Greeks. Gamma is something separate. We're going to skip gamma for a minute because we're going to spend a lot of time on gamma. But just so we understand the other ones, or at least know what they are, theta is a change in the option price relative to time moving forward 1 day. So again, the mnemonic for those who need it to begin with, because, and the reason I say that is because after you use them a little bit, a few times, they become almost intuitive to you. But theta represents time decay, okay? Vega is the change in an option's price relative to a 1 percentage point change in volatility. And again, we have V for Vega, V for volatility. And it's important to keep in mind that the variables are the items on the right. So dollars or price, time, volatility, and the next one we'll talk about, the risk-free interest rate. Those are the variables. The Greeks are the sensitivity of those variables. Okay, and the reason I say that, lots of times I hear people confuse vega and volatility. When they're referring to volatility, they talk about vega or vice versa. So just keep in mind, volatility is the variable. Vega is the sensitivity. Okay, and then we have rho. Rho, beginning with an R, right, is a change in the option premium relative to a 1 percentage point change in the risk-free rate. And I guess you have your choice here. Do you want R for risk-free or do you want R for rate? Either way, it'll get you to rho. Okay, so that's our basic definitions for four of the Greeks. Then we have gamma. Gamma is a little bit different. All the others start out as a change in the option premium. This one is different. It's the change in the options delta relative to a $1 change in the price of the stock. So it doesn't talk specifically about a change in the premium. It's just about a change in one of the other Greeks, i.e. delta. All right. So how does delta work? Well, delta, we'll use these variables, P for premium, D for delta, and M for stock movement, plus for an increase, minus for a decrease. And assuming nothing else changes, just the stock moves up or down, we calculate the new premium this way. We say the new premium is equal to the old premium plus delta times movement. That's a pretty straightforward formula, but you can run into trouble if you don't keep proper track of the signs, because the premium could be a debit or a credit, could be positive or negative. The delta could be positive or negative, and the movement could be up or down, positive or negative. So as long as you keep proper track of the signs, you should be able to calculate the premium based on a change in stock price, once we know the delta. Now this is not going to be precise, by the way, because of something called gamma, but this will get us very close to the new premium value. All right. Now what is gamma? Gamma represents the change in delta, and mathematically, we're not going to use the mathematical definitions. The more accurate mathematical definitions, but gamma represents the second partial derivative of the option premium relative to a change in the stock price. And the analogy that I hear people use a lot is this over here. If delta represents speed, then gamma would represent acceleration. Okay? All right. So gamma is going to indicate the amount of risk or movement that we have with an options position. And a large gamma indicates more risk because the delta is going to move more quickly. Okay? And it moves up or down, but it moves faster. That's what gamma is telling us. It moves faster. And you know, is that a good or bad thing? Well, the answer is it's not necessarily either. It's kind of like leverage. Well, what do you think about leverage? Is that good or bad? Well, if you take $1 and you turn it into $10, you're going to say, gee, the leverage was fantastic. But if you have $10 and you turn it into $1, you lose 9 of them, you're going to say, gee, that leverage was pretty terrible. And it's the same thing with gamma. You might have a strategy where you want a lot of gamma. You want, let's say, a lot of positive gamma, or you want a lot of negative gamma, and we'll talk about how we get those things and what it means. Or you might want a position that has very little or even zero gamma neutral, we could call that. Okay? Now, delta and gamma, just want to give you a sense as to what the range is. And I think, I just want to tell you how I'm talking about delta, about these numbers, because some people would say delta goes from 0 to 1, and that of course is true for a single option. I look at things, and I think a lot of floor traders or ex-floor traders typically do, we look in terms of contracts. So when you buy an option, you have to buy an option contract, and since the contract generally represents 100 shares, we multiply the Greeks by 100. So for one option contract, the delta of a long call is going to be between 0 and 100. Okay, you might see other people say between 0 and 1, but I always look in terms of, view things in terms of contracts. So one contract would go from 0 to 100. Okay, gamma, the lowest gamma could be for a long call is 0, meaning gamma is always positive, and it can be a very large positive number. I'm going to prove that to you a little later on. For a short call, delta goes from minus 100 to 0. And it could be from a very large negative to 0. So short calls are negative, long calls are positive as far as gamma is concerned. A long put has negative deltas from negative 100 to 0, but positive gamma. Okay, notice if we're long options, we have positive gamma. If we're short options, we have negative. The short put has a delta from 0 to positive 100 and a very large negative to 0. Long stock always has a delta of 100 and short stock always has a delta of minus 100. The gamma would be, some would call it 0 and some would say there's not really a gamma for long stock. I think of it as 0 because if we go back to the definition, well, gamma is the change in delta. If delta is always 100, 100 minus 100 is 0. So I go to 0. But if somebody told me NA, I could buy that as well. Short stock, the same thing. I typically would say the gamma of short stock is 0, but you might want to say NA. That's fine. What about cash? I typically ask people, what's the delta of cash? I get interesting answers on that. Since we're not totally interactive here, I'll tell you, it's there is no delta for cash. Some people tell me 100, and I've heard other numbers as well. But think about this: if you have $1,000 in the bank and IBM goes up a point, how much money do you have in the bank? Well, you probably still have $1,000. there's no impact at all. So there's really no concept of delta for cash. All right. So how does gamma work? We saw how delta works. We have a similar type formula. Delta, D is for delta, G for gamma, M for stock movement. Assuming that nothing else changes, then after a movement of M, the new delta is going to be calculated this way. New delta is equal to old delta plus gamma times movement. And again, same caveat, just be careful as far as the signs go. Otherwise, it's a pretty straightforward formula. Okay, so how does gamma work? Well, we already have, we see something that it's used for. We see that we use it to calculate our delta. Positive gamma generates positive deltas as stock increases and negative deltas as stock price decreases. Kind of interesting, right? This sounds like it's very good for us. We're getting longer positive deltas. Think of deltas as ESP, equivalent stock position. And so we're getting longer as the stock price goes up, which is what we want. And we're getting shorter, we're getting negative deltas as the stock price goes down. So it's making us short on the way down, long on the way up. Sounds like a pretty good deal. Well, but we'll have to investigate that a little more closely. Negative gamma is going to work in the opposite direction now. Negative gamma is going to give us negative deltas as the stock price goes up and positive deltas as the stock price goes down. So it's making us, excuse me, so it's going basically in the wrong direction. It's making us long with the stock going down and short with the stock going up. We want to be long with the stock going up, right? We want to be short with the stock going down. So we're going to have to take a look at what's going on. So if we're expecting stock to make a move, we're going to want to have, it's a general rule right now, we're going to want to have positive gamma. If we're expecting the stock to stay still, we're going to want to have negative gamma. Okay. So here's an example of how we combine deltas and gammas. It's also true for some of the other Greeks, for theta, vega, and rho, and even some Greeks that I didn't mention that are not as popular, vama and vana. But the Greeks are generally additive. If we're talking about a particular underline, then we could add them up. We can't add the Greeks for IBM and Microsoft or any two different underlines, although there even is a way to kind of do that. We relate everything to an index, but that's beyond the scope of what we'll talk about today. Anyway, I have a made-up position here, and all three of these options, if I could use this pen, make a position. Okay, and each one of these options is called a leg. So in this case, we have three legs that make a position, and we're long 10 of the Jan 35 calls with a delta of 60 and a gamma of 7. You see what the other ones are. And so the way we come up with our position delta and position gamma is we multiply the number of contracts. In the first leg here, it's 10 times 60, that's 600 deltas and 70 gamma. In the second situation, I wanted to show negative numbers. We're short 8 of the Jan 30 puts. Puts have negative deltas and positive gamma, right? So I multiply negative 8 by negative 25. I'm long 200 deltas for that leg, and I'm short 24 gammas. Short is negative is short. Okay, positive is long. All right, and then I'm also long 10 of the Feb 40 puts, and so my delta there is minus 500, 10 times minus 50, and 40 gamma. We add them up and we say the delta of this position is 300, the gamma is 86. Now what does that mean? Well, it means over a small range of places.
Turn that into an actual trade. How do we manage the trade? How do we find trades?
Stan, are you there? Can you hear me?
Trades, those kind of things.
Seems like your mic has dropped off, son. So can we do some corrective action? Sorry about this, folks. Give me a second. We'll try to work with Stan behind the scenes, and we'll get right back to you. Yeah, thanks, folks. Yes, we know. We've got a sound problem. We're working on it. We'll be right back to you.
That kind of really
All right,
Whoa,
Stan, can you hear me?
Yes, I hear you.
All right, I hear. Everybody get Stan?
Are we back? Okay, it sounds like people are hearing me. I just want to say I am so sorry. I have no idea what happened. My mic is indicating that it's working fine. but I logged off and logged back in, and now you could hear me. I'm very sorry about that. No idea what happened, but okay. Yeah, let's continue. So I had shown how to calculate the delta of a position and the gamma of a position, and I said it's going to act like 300 shares of stock, and it's over a small range. And the reason it's not over a wider range of stock prices is because as the stock price moves, the gamma is going to kick in, and so this 60 delta or 600 deltas here is not going to remain at 600 deltas. It's going to change. Okay? So that's, that's something we want to keep in mind. All right, but let's move forward. So what about gamma, time, and moneyness? Moneyness is being in the money, at the money, and out of the money. And we have a few things. Two of these I'm going to prove to you. A put and its corresponding call option have the same gamma. That's not an obvious thing. Puts have positive deltas, calls have negative, puts have negative deltas, calls have positive deltas. Why should their gamma be the same? Well, I'm going to show you. At the money options have more gamma than either the in the money or out of the money options. And long-term options have very little gamma. So near-term options can have very large gamma. And I want to prove that to you as well. Okay, so let's see if we could get to that. Now, here it just says from synthetics. And what does that mean? Well, this actually happens to be very important. Sometimes I write it out in more detail, but it's not the focus of today's presentation. What it's saying is a long call and a short put is going to act like long stock. Call minus put is equal to stock. Now, obviously, numerically, this doesn't work, right? If a call and put are each about $3, we'd have 0 on the left side, and a stock might be 50 bucks. So 0 is not equal to 50, that's clear. So what does it mean? Well, it means if we buy a call and we sell the corresponding put, same strike, same expiration, that position will gain or lose the same amount as stock would. Okay? So percentage-wise, it's going to be very different, but the dollar amount of gain or loss should be the same. Now, there could be small differences, very small, but basically it should be the same. And theoretically, it should be exactly the same, but in practice, we have bid and ask pricing and things of that nature. All right, so let's just start out with that. And if you're not familiar with this synthetic, then I suggest you do learn about synthetics because they're very important. One that I think a lot of people are already familiar with, just to give you an example, is stock minus call is equal to short put. So long, that's a covered call. Long stock and a short call is synthetically equivalent to a short put. And again, not numerically, but synthetically. In fact, I used to put a little S over the equal signs here. It drive everybody, including myself, crazy. So I stopped doing that. All right. So what I'm going to do, call minus put is equal to stock. Let's take the delta of both sides of that equation. And so we have call delta, the C for call, P for put, minus put delta is equal to stock delta. We already said stock delta is equal to 100, right? Okay. Then if the stock goes up $1, for example, what's going to happen is I'm going to replace the call delta by call delta plus the gamma, the call gamma, times 1. I don't show the times 1. And we have the same for the put. The put delta is being replaced by the old put delta. The new put delta is being replaced by the old put delta plus the put gamma. And since this is all minus, we have a minus sign there. So that's where this equation comes from. And then just subtract equation 2 from equation 1. And what we're going to end up with is call gamma minus put gamma is equal to 0, or call gamma equals put gamma. Okay? So that always has to be true. All right. What about proof that the gamma can be very large? Well, consider a 75 call with, let's say, 1 day to expiration. All right. So we should know that the delta of an out of the money option with the stock at 74.90, the 75 call is out of the money. This is approaching zero as we get closer and closer to expiration. But with about a day to go, the delta might be around 5, maybe it's 3, but for our purposes, the exact number doesn't matter. Okay, let's say it's 5. And here we have an in-the-money option. The 75 call is now in the money if the stock is at 75.10. And that delta would be approaching 100. At expiration, it would be 100, just like this would be 0. So let's take a look. We have a 95 delta option with the stock at 75.10 and a 5 delta option with the stock at 74.90. Well, we know that gamma is a change in delta over a change in the stock price. We could take 95 minus 5 and divide that by the change in the price, 75.10 and 74.90, 20 cents, and we get a gamma of 450. Now, if you've looked at options for any period of time, you'll know that's a huge amount of gamma. That's really going to change very, very quickly. So if there was even less than a day to go, it would be even higher than that. So gamma, as you get close to expiration, can be very, very large. Now this gives us some implications as far as our trading goes, right? Because we know that a change in the stock price is going to, because we have such large gamma, is going to change our delta very quickly. So trading very close, trading with large gamma very close to expiration can work out well if the stock makes a big move. But on the other hand, if it doesn't, well, what happens then? We're going to see in a minute. I'll give you a hint. It's a theta issue, but let's take a look. Gamma and theta. The gamma of a position can be positive, negative, or 0. Buy options for positive gamma, but then you get negative theta. If we sell options to get negative gamma, then we're going to get positive theta. Okay. So if we want a neutral gamma position, what do? We have to do some ratio. We have to buy some, sell some, and we can end up with either positive or negative theta with neutral gamma. We don't know for sure which way it's going to go. We have to take a look at any particular situation and make a determination. Gamma and theta are directly proportional, although the signs are opposite. And something that's quite key here, and maybe that's what you're getting from this, and that is that we pay, the way I look at it at least, we pay for gamma with theta, okay? We pay for gamma with theta. So to get a lot of gamma, positive gamma, we're going to end up with a lot of negative theta. If we sell gamma, in other words, we're short gamma, we're going to have positive theta. So there's implications depending on what we're looking for relative to our trading, you know, when you think about it in these terms. Okay, what about gamma and vega? Well, vega of a position can be positive, negative, or 0, just like any of the Greeks. Gamma and vega are inversely proportional. So what that means is if we have high gamma, we're going to have relatively low vega, and vice versa. If we have low gamma, we're going to have relatively high vega. So if we're trading long gamma, we generally want to be short term, although there are situations where we trade long gamma, particularly something called gamma scalping, which was a strategy. A lot of people didn't like it because commissions and expenses were very large. Now it's come into vogue again because commissions are relatively inexpensive. And so for gamma scalping, we're not going to talk about that now, but yeah, we we want to be long gamma and also long term. So that's a little different than what it says. But generally, if we're trading long gamma, we want to be short term. And if we're trading long vega, we generally want to be long term. Okay. Now here's the gain from gamma in a delta neutral position. And this is really, you have to follow it a little closely here, but it's kind of interesting. You'll pick up a lot if you focus on it with me. So we have a stock at 75, a zero delta position with a gamma of 100. And there's lots of ways of making that position. I think I have it on the next page, or maybe a couple of pages. Anyway, so if the stock goes up $1 to 76, our new delta is going to be 100, right? Because it's our old delta, 0, plus 1, positive 1, times the gamma to give me a new delta of 100. Now the average delta over that period, it started at 0, ended at 100. It's going to be 0 plus 100 over 2, or 50. So over that period from 75 to 76, that range, I have an average delta of 50. The stock went up $1, so my gain is going to be $50. You see it over here, right? 50 deltas times a movement of $1 up. On the other hand, if the stock was 75 and went down $1, it would go to 74. My delta is going to be minus 100 now. It's going to be the old delta, 0, plus minus 1 times 100, or minus 100. And so my average delta now over the range of 74 to 75 is going to be minus 50, 0 to minus 100 over 2, minus 50. But the stock has gone down $1, so we multiply minus 50 by minus 1. And again, we get a $50 gain. That's pretty cool. The stock moved up, we made money. The stock moved down, we made money. What if the stock moved up a different amount? Well, you could take a look at this one, but I want to get right to the general formula here. What if the stock moves up M? M for movement, right? And actually M could be up or down. It could be minus 50 cents or plus 50 cents. And in the case right above it, it's plus 75. So we could use that as our example. So the stock price, if the stock moves up M, is going to be 75 plus M. The new delta, it started at 0, so it's 0 plus gamma, whatever the gamma is, times the movement. And so my new delta is mg. My average delta over the period from 75 to 75 plus m is 0 plus mg over 2. And so my gain or loss is my average delta times the amount of movement. So my average delta is right here. My movement is the m. And so here's a formula you're not going to see in too many places. And this was a very useful formula for us on the floor, but I think it's also one that's useful for retail traders. It's telling you that the amount of gain that you're going to make on a delta neutral position, 0 delta, with a gamma of g, whatever it is, in this case it's 100, but it could be anything, is equal to g times m squared over 2. Okay? Now, let's just take a look at how would you use something like that. So we have a position that's delta neutral. Well, we also have to reflect time decay. So I'll take out the time decay here. And that's really my gain, right? We'll modify it on the next page for one more time. But for right now, it's gamma m squared over 2 minus theta. Okay, so the way some guys on the floor would use this formula, they'd say, gee, I need to make $1,500 today or 5,000 or whatever their number was, and they'd plug it into the formula. They'd say, I have a position, it's delta neutral, I have 1,500 gamma, theta is 200, and I want to make, let's say, $1,000. Just plug it into the formula, and then you could solve for m. And in this particular case, you could check it later if you'd like, you get that the movement is either a gain of $1.26 or an increase of $1.26 or a decrease of $1.26. Either way, I would make approximately, we have to always say this is approximate, but you'd make approximately $1,000. We have a way of calculating what our gain or loss would be based on the movement and using our formula. Now, what if the position was not delta neutral to begin with? All we have to do is add a term to reflect the deltas that we're starting out with. Well, that's easy, right? We're starting out with a delta of D, and the stock moves M. You don't have to make any adjustments here because that's all taken into account in the next term, right? So this would be our total gain for the day, obviously not including expenses of any type. Obviously, if volatility is changing, some of these terms would change a little bit as well, right? If volatility changes, my delta might change. And by the way, just to whet your appetite, that's what Vanna, it's another one of the Greeks. That's what Vanna is all, V-A-N-N-A. That's what Vanna is all about. And the same thing with gamma. If volatility changes, your gamma is going to change, and your theta will change a little bit as well. All of them could change a bit, but typically from the beginning of the day to the end of the day, unless something is actually happening, you're not necessarily expecting too much of a change in volatility. So this is a formula. I don't think you're going to see it in too many places, but I believe it could be very useful to you. Okay. All right, here, sometimes I do some calculations here, but I'm not going to do those now. Here, I wanted to show you how we could have a delta neutral position with positive gamma. I'm just showing you 3 different ways we could make it. We're only using 2 options. We have the stock at 75. The 75 call has a delta of 60 and a gamma of 5. The 75 put has a delta of minus 40. Right? We know that relationship between the call and the put deltas. Call delta minus put delta has to equal 100. 60 minus 40 is 100. And the gamma of the 2 has to be equal. In this case, they're both 5. So I could make a position like this. I could buy 8 of the Jan 75 calls, gives me 480 deltas and 40 gamma, and buy 12 of the May 75 puts, negative 480 delta and 60 gamma. And so I have a delta neutral position with 100 gamma. Okay? 0 delta, 100 gamma. I could also buy 20 of the May 75 calls, gives me 1,200 deltas and 100 gamma, and just sell short, by selling I mean shorting, 1,200 shares of stock. And again, I have a 0 delta position and 100 gamma. And then finally, well, I shouldn't say finally, because there are so many different ways we could come up with the same thing with a 0 delta and 100 gamma. But here, I'm buying 20 of the May 75 puts. That gives me minus 800 deltas and 100 gamma. So all I need to do is sell 800 shares of stock. And again, I have a delta neutral position and 100 gamma. Okay. So it's easy to create these positions if you just think about what you have and you put them together. And in fact, in practice, this is nice and neat, exactly 60, exactly 40. But in reality, they're going to be, a little bit different. It might be 62 and 38. And so we might end up not having exactly 0 deltas for a relatively small position. But that's okay. I mean, it doesn't have to be exactly 0. It doesn't have to be so nice and neat. Here is, well, this is something, I have a theoretical pricing sheet that I believe is very useful. All my students get copies of it. This is an abridged version of it. If anybody wants to get a copy of it, just send me an email. Happy to send it to you. It shows for the correct theoretical pricing for a stock at 55 and a 45 volatility, risk-free rate of 5 with no dividends. It shows for various strike prices and some expirations what the correct premiums would be, correct theoretical premiums, and also the Greeks that go along with those premiums. Okay. And here's a, I guess we have a couple of minutes. I'll just show you this. I call it a bonus formula. I think very few people know this. I haven't seen it. Actually, there was an option book from years ago that did have something like this. But it's kind of a useful formula. It gives you a very close approximation as to the at-the-money straddle price. I'm not going to go into the derivation now, but it's 0.8 times the stock price times the volatility, and this is the implied volatility, times the square root of time, where time is in years. So, and here's an example I put together. So for the November 55 straddle, we just plug it in, 0.8, 55 straddle, so it's 55. The volatility of 45, this is using that sheet that I showed you before, this sheet over here. The volatility is 45, and with 35 days to go, that would be the middle column, it tells me that the straddle should be 613. The actual value, when you put in the correct theoretical numbers, is 610. So it's a very, very close approximation. In fact, well, yeah, it's the 0.8 that's actually, we could adjust that to make this even more exact. But I think all the floor traders I know, we always use 0.8. So this could be useful to you. And I think there was one more. Yeah, one more. This one, I'll just tell you what it is. I see it's time I better start wrapping up. So the at-the-money straddle gamma to theta ratio. Now you might say, why would I care about that? For certain types of trades, the gamma theta ratio is very important, particularly for gamma scalping. It's more or less critical. And there's some other trades also where you want to know what the ratio of gamma to theta is for the at-the-money straddle. And here's a very, very close approximation. It's 730. 730, where'd that come from? I don't know. Somebody's interested, just let me know. 730 divided by the stock price times volatility squared. So let's just take a look at an example. Here we have the November 55 straddle gamma theta ratio. So I'm saying take 730 and divide that by 55 times 0.45 squared. Comes out to $1.19. And it just happens in this case, it comes out exactly to the right number. Sometimes you might be off by a penny or two, but in this case, it's exactly right. 518 being the gamma, we know the all and put gamma are the same, and 471 and 396. Just want to show you where those numbers come from. So we have the, where was it? The 55. Yeah, 545 and 4, is that the one? I lost track of it already. Oh, here it is. The gamma, the 518, the gamma for the call, and 518 for the put, and 318 and 292 are the prices as far as the straddle goes. Okay? So we have the gamma, and the theta is the 471 and 396. So without looking at this, we could tell what it should be just knowing the other information that goes into the formula, namely the stock price and the volatility. Okay. All right. So let's just recap a little bit. The Greeks are kind of very important. You know how I feel about them. They're your gauges when you're driving a car. The same when you're driving an options position, they're your gauges. You need them. They're critical. Gamma is the secret sauce. Don't let somebody tell you that it's not important. Understanding and harnessing it is really critical. More so for spread trades, by the way. I don't know if I mentioned that, than individual option trades. Almost everything personally that I do is a spread trade. But yeah, particularly for spread trades. Some strategies are designed around gamma. I might put on a position where I want to have a positive gamma or negative gamma or no gamma. In fact, I have a program that I wrote that you tell the program what you want your gamma to be and what you want your vega to be and what you want your delta to be, and it designs the strategy for you based on a set of options. So that's how important I think it is. When stocks are moving, you want to trade long gamma and short-term strategies. Do I hear earnings? You know, that's stocks typically move a lot, and you know, and they happen quite regularly. We could time it to where we want, and there's lots of different ways to trade earnings. I'm not saying just go out and buy a call or buy a put or something like that, but you want to take your gamma into account. Some good long gamma strategies would be a reverse calendar spread, as an example. But they're difficult to implement unless you have portfolio margin. And because of the way that the margin rules work, well, I could talk a lot about margin rules, but I shouldn't get started on that. But portfolio margin makes this kind of a trade, a reverse calendar, and other trades that are like that, where you short something near term and long something farther out. Yeah, where you long something near term and short something farther out. I think I said it backwards. It really helps if you have portfolio margin. And the truth is that now, if you go back and look at the slides, which I'll show you how to get them in a minute, you have more knowledge about gamma than most retail traders, and probably even some floor guys who might have forgotten some of this stuff. Anyway, what you want to do now is think, how could we use this to make profits? I gave you some ideas, but think about it. There's a lot you could do with understanding gamma. Okay? All right. So I just want to take, here's the riddles that we started out with. I think I already mentioned the answers. The first one is his son, the second one is Sunday, and the third one is 50%. If anybody sent me the correct answers before we started, I'll make sure that you get a prize of 6 months, whatever I said, 6 months or 3 months of the Option Strategist newsletter. Well, since I'm saying 6 now, we'll make it 6 regardless of what I say. Okay. And just a little bit about McMillan Analysis. That's the company that I work with Larry McMillan. We provide a lot of things: trade advisories, money management, education material, software products. Personally, I do consulting projects to institutions, hedge funds, and individuals. And I started and run a one-on-one mentoring program. If anybody's interested, just give me a call. I'd be happy to tell you about it. I want to thank you for spending time with me. We do have some specials, things that are 50% off our normal website pricing. Just go to optionstrategist.com/TS for TradeStation 18. You'll also get a copy of the PDF if you'd like it. What else? Oh, yeah. And for my mentoring program, I have something called a tuition reimbursement program, and TradeStation is part of that. And what happens is, if you sign up for the mentoring program, you'll get rebated commissions from TradeStation. I think periodically they rebate some of the commission expense. I think it's 20%. And their commissions are great to begin with. So this really, this makes it terrific. And you end up basically not paying for the mentoring if you trade enough. If you make enough trades, you could recover the cost of the mentoring. Okay. And then if you're interested in the mentoring, just call me or send me an email. I'll just put up my contact information. Oh, that is my contact. Yeah, that's all of it. I thought I had another page. All right. So again, thank you all for listening to me. I hope you learned something from it. I hope I made things clear. And I'm so sorry that the sound went out for a while there. But hopefully it should all be together now for the recording. Okay, so thanks again.
Hey, Stan, thanks so much for spending time with us this afternoon. We really do appreciate your partnership with us here at TradeStation. And to everybody that attended today, thanks very much for coming to TradeStation for this educational webinar. We'll be back with you tomorrow, 1/2 hour before the market opens for the morning market briefing. David Russell from TradeStation's own David Russell will be with us in the morning. He's our director of, or VP of content strategy here at TradeStation, and he'll have a number of interesting outlooks for you for tomorrow's trade. Let's have a great night. We'll see you again.